For me, I think it opens up smaller deal sizes and makes smaller deal sizes economical. And we see this at Maple with the ability for us to compete for sort of like smaller middle market crypto native institutional business. And I worked at Avalanche for a year, and I saw that with a lot of the private equity funds we were working with to tokenize their flagship funds and distribute that into the new crypto native high net worth base of kind of deluxe retail. And they really wanted to push their products to those types of people. And because they were building those funds on chain and tokenizing them in such a way, they were able to lower the investment minimums on those products because the economics got better. They were able to cut out some of the costs. So keep it super basic. I think that's a no-brainer.
Yeah, I think that I'll just get like one inefficiency, which is being able to integrate finance into other applications and other workflows rather than having it be completely siloed in a separate UI and back and middle office, where because you're putting this stuff into logic that is code that is, meant to be integrated, it's just a lot more extensible in terms of embedding it into other apps, products, workflows, and being able to do that just has like natural efficiencies in terms of management costs, all that good stuff.
I think for me, probably permissionlessness. The panel before us was talking about Athena, and so I think about that protocol giving anyone access to the basis trade, right? Typically a trade that in crypto people like Wintermute could harvest, or this thing has been around for decades and decades in traditional markets, and in crypto we can wrap this into a composable financial product that anyone with a small amount of collateral in their wallet can access. So I think permissionlessness and then verifiability of who owns what, who has what permissions, and who can do what with which assets. Those are probably the two biggest inefficiencies.
I would like to talk more about the institutional lending kind of a part, B2B kind of a lending. Especially in the TradFi setup, what happens is it's a one-to-one mapping. A bank is investing in other financial institution, or maybe two banks are investing in senior and junior tranche in a particular deal in a particular financial institution. But because of on-chain lending, even the retail capital as well as institutional capital can flow in a one particular deal. And the ticket sizes could be for retail smaller, and institutional can come in with millions of dollars or bucks in the same particular deal. So that's the biggest one. Apart from that, there are like a lot of intermediaries involved, especially the institutional lending. The auditors, the custodians, there are tons of service providers you will find. They'll work on Excel sheets, like everyone needs to coordinate with everyone so that cost gets optimized. You get the real-time visibility of the net asset value, the performance of the portfolio and all of that stuff. Yeah, so these are a few of the inefficiencies which are being solved by on-chain lending.
That's a very interesting point. So just going back on that, in traditional finance, other than P&L opportunity, which is the same for a Wintermute or a big, tier one bank, the main concern is A, capital efficiency. Does DeFi really sell for that? And B, counterparty risk. I know that you guys are very heavily involved in counterparty risk assessment. What's your view? How does on-chain rating assessment can work for counterparty risk? Right now, we as the biggest market maker always looking for solutions, and we haven't found a perfect one yet.
So as far as the risk assessment part or credit underwriting, or for that matter rating system matters, so if a marketplace or a particular RWA lending protocol says that this is a good deal, you invest in it, you are heavily relying on that one particular party. Although the capital is being sourced from the DeFi world, you are centrally dependent on a one particular party or a underwriter or a group of underwriters from the same protocol that this is right and you invest in it. If things go south, things go south. If it works out, works out. And if you look at the default, so DeFi is suffering 4x more losses compared to TradFi. So there are two ways to go about it. Either you work with multiple set of underwriters and then come to a conclusion that if the particular deal is good or not. Or maybe you need to have a middleware which kind of works with network of underwriters, where most of the underwriters will look for the same set of data, 80% of the data, but the risk associated with that particular case and the evaluation of that risk is different. That's how each underwriter looks at based on their risk appetite. So essentially, that middleware infrastructure is required, which will work with different RWA lending marketplaces. where data can be streamlined, put it in a structured format in the ratios. On the top of those data and the ratios, the credit policies can be run, so that you can make a lot of sense out of that particular data, rather than just saying that the rating of this particular company is good and invest in that particular deal.
Okay. Yes, please. I was going to ask you.
There is no great way to do credit underwriting on chain today. You need professional credit underwriting in the traditional manner. And we've gone through this at Maple, right? We started in 2021 as an uncollateralized lending protocol. We had a number of third-party credit teams on the platform. Today, we've brought all of that credit underwriting in-house. We have the best risk management expertise in the industry and the best ability to evaluate counterparty risk. And on top of that, we're focused on secured lending. So I think where it gets really interesting is if you can build in programmable security into a loan. So that can either look like programmable collateral in the form of digital asset, or hopefully in the future, when you have full businesses that are built on chain, programmable cash flows from those businesses that get allocated towards lenders.
I want to add one point over here. So usually whenever I spoke to these different RWA lending marketplaces, what I have realized, their investors are always looking for a third perspective. So although the marketplaces will always downplay the risk and they'll say that this is good and you're getting these kind of returns, but the investors, especially the institutional investors, they always want the third point of view of the risk associated with the deals which are listed on the marketplaces.
Yeah, I mean, we do things in the same way that Luke described at Maple. I think what's valuable in adding third-party, let's say kind of on-chain underwriting on top of that is that if Maple or OpenTrade does their own underwriting process in-house related to the assets we do, if there's other parties that are able to kind of like review our review and then do an attestation surrounding that others can see within DeFi, I think that's a cool extension of bringing finance on chain, and just anything that brings more comfort to users and companies is always good. But yeah, when it comes to putting out a structured product, it's really hard to not do most of that kind of yourself in a lot of ways.
Yeah, I guess an interesting, tricky question here for you. So we think we're the best crypto credit in this space, right? We have the biggest balance sheet, 3 billion balance sheet among all the crypto native firms. We have 1 billion net equity. So we believe that we should be able to borrow uncollateralized and just provide visibility of our financial kind of activity on a monthly basis. Do you feel like credit rating can really ever be 100% on chain, or will it always require off-chain verification? Because right now our balance sheet is off-chain, right? Even our assets that are held on chain are only permissioned on a need-to-know basis for some of the protocols that require that on a daily verification basis. So it's not really 100% on chain, is it?
I'll let Luke take that one first.
No,
it's
not.
Question.
I think we're a long way away from that. I do think there are interesting ideas and primitives and things that are very theoretical at this point that are heading in that direction. And if you sort of squint, you can start to put a picture together. But I think we're a long ways away. I want to see people lending against Qiro profiles and ethos and all of these new kind of social credit score things to individual wallets on chain. And see how that experiment goes.
So what I understand is on-chain lending is very at early days right now. It has long way to go. So if you look at the TradFi lending, there are unsecured loans, multi-billion-dollar books, profitable ones are being built by tons of these fintech companies. They're doing it. So why are we not able to do it? Because we don't have a historic data of 5 to 10 years to underwrite and come across a conclusion that this financial product or this particular thing will work, and you are able to make profits out of it, and how to evaluate a risk. So most of the times what happens is the data in the off-chain setup is in unstructured fashion. The documents, the photographs, the Excel sheets, the Word docs. So you have to kind of streamline all that data. Although we are saying that it's on-chain lending, you are just evaluating, someone is saying that this is the net asset value of this particular asset. Someone is evaluating that asset. On the basis of that, you are doing the on-chain lending. But still that off-chain data needs to be evaluated in a structured fashion. You do the off-chain computation and post the results on-chain. And on the basis of that, probably you can do something about uncollateralized lending or semi-secured lending, or maybe fully secured and over-collateralized anyway. it's no-brainer. It's the matter of fact that when things go south, probably how soon you can liquidate it.
I think you can even look at some of the bigger borrower blowups within crypto too, where these people actually took advantage of the off-chain verification. So if we look at something like a Celsius or a Three Arrows, right? They had to pay the protocols back first. They didn't get to negotiate with the lending protocols on chain. They had to pay all of those on-chain loans back, and then they took advantage of the off-chain loans that they had with certain counterparties, and then they got to take those to court. So they took advantage of gaps in the off-chain verifiability, but when these loans are fully programmable, they can't negotiate with that. You can't really sway those one direction or the other.
Yeah, very true. I like how we're bringing, different perspectives into the conversation. So let's say you're speaking to, TradFi folks, right? And the biggest elephant in the room, let's admit it, it's always the hacks, right? They're like, well, why should we bring billions on chain? There's hacks that are happening every week, every day, etc. How would you try to convince them that the efficiencies that are, there are other types of risk, not just counterparty risk. There's like settlement risk. There's, many other types of risk. How would you convince them that hacks are avoidable and the efficiencies that on-chain finance brings is still worth considering doing something on-chain? Again, to give you a little bit more perspective, I know that some of the biggest tier 1 banks, we speak to them, have 12 people who work on Solidity developers for the last 4 or 5 years. Do you feel like they will really ever come on-chain in a permissionless way, or will it be always walled garden where banks are still trading with banks in kind of that walled garden environment?
I think they're kind of two separate buckets. The cybersecurity risk aspect versus banks moving into a completely permissionless world. I think on the latter, I just don't see banks going into a permissionless world because they make their money off of establishing the completely permissioned world that they run and maintain. And so I think that from a kind of like board level at tier 1 financial institutions, I think they're a really long way away from jumping headfirst into permissionless use cases that just have so many glaring things that for them threaten their business models and their dominance. And then on the cybersecurity side, I mean, obviously there are a number of cybersecurity issues and a number of hacks that happen throughout crypto. They're very well publicized. I think there's also a lot of cybersecurity risks that are exploited in traditional finance that are not as well publicized. And so I'm definitely not a cybersecurity expert in any way, and so this is all just anecdotal, but I think that if you were to look under the hood at cybersecurity risks that are both present and have been exploited in traditional finance, that it might actually look kind of similar over a broader time horizon to what we see in crypto. But what I will say is that, obviously with crypto, what we see recently, the seems to happen a lot quicker. And the exploits seem to be a lot bigger and a lot quicker. But so don't see banks getting into the permissionless realm anytime soon. And cybersecurity, I think everyone has issues that they're addressing and that are visible or not visible in certain ways.
Yeah, I'll go ahead. Agree with Jeff, and it's okay that traditional financial institutions aren't going to be coming into permissionless DeFi. They can use permissioned DeFi. They can use Avalanche subnets. They can use their own L2 rollup that they're building. They can use Maple. We have permissioned DeFi infrastructure, and then we have permissionless DeFi infrastructure with Syrup. So we've kind of built it for both parties. We have some large institutional asset managers that have come on and have just lent into Maple very recently, and that's been their first interaction with all of DeFi. That's happening on Ethereum mainnet today, but it's fully gated, permissioned, KYC'd, onboarded. Those LP tokens that they own are whitelisted. Even if their wallet were to be hacked, those wouldn't be able to be transferred or sold on a secondary market. Different story for Syrup lenders on the permissionless side. We've just launched a bunch of secondary liquidity for people to go out and swap their stake in a pool of institutional loans with real secondary liquidity on chain. So it's just going to look different depending on who's using the product, but there's no reason you can't set it up to meet the needs of everyone.
To his point, I think it's a matter of the programmability. Like you have a permissionless backbone of Ethereum. a broad spectrum of ERC20 assets on top of that, ETH itself being totally permissionless, and then you have smart contract logic on top of that. You have hybrid solutions, private pools, permissionless pools. You can meet any of the business use cases, whether someone is willing to go after bigger risks, play in permissionless markets like Wintermute, or whether someone has very, very hard like KYC, KYB requirements that they have to meet in a more gated setting. So you can tackle this at the network level, you can tackle this at the asset level. I think the infrastructure there is there within our space to suit those use cases today.
Okay, great. I guess to round up, the last question I have for you is again very, very broad. Is what excites you the most about what you're building, and what are your top predictions for the future in terms of finance on-chain development?
We're starting on your side.
Okay, perfect. So as far as my take is concerned, so I'm very much excited about bringing the credit underwriting on-chain. So we are not just talking about solving credit underwriting and the risk assessment part just for the private credit use case, but we also look for a fact that there is a deep in financing, there is embedded financing, different kind of a use cases can also be solved. And ultimately, although the marketplaces are different, the underwriting infrastructure and the base data point and the ratios remain same. How you build the credit policies around it is going to be different. So we want to be that middleware and that infrastructure which can support these different use cases. And I'm more excited about that, starting with private credit and then deep in financing.
For us, I think within the financial realm, I think chains are the perfect substrate for people that want either a permissioned or permissionless environment to do finance. So we can have awesome general purpose ecosystems like something like Plume, or we can have a small environment that's maybe for 3 or 4 counterparties so that they can transact with each other and have security guarantees from something like Ethereum L1. So I think it's supporting a broad spectrum of teams, but really supporting if the compromise we have to make to get JP Morgan on chain in a sustainable, repeatable fashion is like a permissioned, gated network, it's a compromise I think we should be willing to make and excited about.
Well, I think like one of the things people have always talked about in crypto since I've been in for like a decade is when are we going to see the killer apps for mainstream adoption? When are we going to see the killer apps for mainstream adoption? And what we've seen over this year is it's already happening right now, and it's pretty exciting. We allow neobanks and centralized exchanges to power real-world asset-backed yield products for their end consumers, and so these are typically retail users that are using neobank apps, the equivalent of like a Venmo but in Colombia. And so, we already this year see that hundreds of thousands of people in Colombia have a US dollar and euro savings account that they earn interest on with a click of a button. Behind the scenes, it's stable coins and things like OpenTrade's RWA-backed yield product. But for them, they know we're not being not transparent, but they don't need to understand it in order to get value from it. And so, I think we're seeing this year like the compilation of different companies, different apps, and all this that are actually delivering like real utility value for everyday users. So we're still going to see obviously everyone say when's mainstream adoption and when's that's going to keep going, but I think we can walk away from this knowing that it's actually already happening and it's pretty cool.
Yeah, well said. I'm going to be that guy. I'm going to say the convergence of AI and all of the stuff that we've talked about today. I am very excited about that. So when you think about stablecoins, on-chain finance, and then plugging in AI into that equation, that gets really interesting. One of our co-founders and I worked on a piece a few months ago called Maple 2030, sort of casting our vision for the future. And I think the opening statement from that piece was, by 2030, you'll have $100 billion of stablecoin pools on Maple that are being allocated by AI agents across all of these different credit opportunities. So that could just be pie in the sky, but I think it's a pretty interesting vision.
I love the predictions, and I hope it's a self-fulfilling prophecy. Do we have any questions from the audience before we wrap up? No. Okay, perfect. Please give a round of applause to our panelists, and please meet them after the panel later.